Last spring, a retired gentleman named Arthur walked into a car dealership in Ohio. Arthur was 64 years old. He had been retired for exactly 4 years, and he had lived his entire adult life completely debt-free. He had plenty of liquidity sitting safely on the sidelines, and in his jacket pocket, he carried a cashier's check for exactly $48,500. He walked up to the sales manager, looked him in the eye, and said the words that almost every disciplined retiree is proud to say. "I'm paying cash today. Give me your absolute best price." 90 minutes later, Arthur walked out of that dealership with a set of keys, fully convinced he had outmaneuvered the system and secured a massive discount. But by the time my firm finished auditing his final sales contract, we had to break the news to Arthur. Arthur didn't save a single penny by paying cash. In fact, he quietly overpaid by roughly $3,800. And the tragedy is, if he had said just one different sentence when he first crossed the showroom floor, that $3,800 would still be sitting securely in his bank account today. For nearly 30 years, we have watched disciplined, highly intelligent retirees fall into this exact same trap. Today, we are pulling back the curtain on why cash buyers are actually easiest customers for a dealership to overcharge, and the single, simple counter move that completely flips the leverage back in your favor. If you've played by the rules your whole life, paying off your mortgage, avoiding credit card debt, and building a secure nest egg, your financial instincts will tell you to do one thing when making a major purchase. Pay cash, skip the interest, avoid the finance office entirely. It sounds logical, it's exactly the kind of wisdom that got you to retirement in the first place. But in the modern auto industry, that wisdom is completely wrong. If you believe that a lifetime of hard-earned financial discipline deserves to be protected, not quietly exploited by predatory corporate sales systems, do me a fast favor. Hit that subscribe button right now. Let's keep your hard-earned dollars out of their pockets and inside your portfolio. You see, a car dealership does not generate revenue the way your local plumber or contractor does. If you pay a plumber in paper cash, he bypasses a credit card processing fee of 2% to 3% and passes some of those savings back to you. But when you tell a car dealership you are paying in cash, you aren't saving them a fee. You're actually removing their single largest profit center from the entire transaction. And when you strip that profit center away, the system is designed to claw that money back from you somewhere else every single time. Let me show you exactly where the dealership's real money is made. And hint, it isn't on the shiny showroom floor. When you negotiate a car purchase, you probably bring your Kelley Blue Book value, your Consumer Reports printout, or your Edmunds invoice sheet. You fight tooth and nail for 2 hours to get the salesperson down to $50 over the invoice price. The sales manager looks wounded. He sighs and tells you he is literally losing money on this transaction just to earn your business. It is a beautifully choreographed lie. The dealership already knew the invoice number days before you arrived. What those public pricing reports never show you are the private back-end financial arrangements between the manufacturer and the dealer. These are the 5 hidden profit streams that never appear on your window sticker, never show up on your invoice, and are never disclosed to your face. First is the dealer holdback. After a car sells, the manufacturer quietly cuts the dealership a check for 2% to 3% of the total sticker price. On a typical $45,000 vehicle, that is an immediate guaranteed profit of $900 to $1,350. That is completely invisible to you. Second are dealer cash incentives. When a manufacturer has too much inventory of a specific model sitting on regional lots, they pay the dealer direct bonuses just to move the metal. Third are volume stair-step bonuses. If a dealership hits their quarterly sales volume target, the manufacturer pays them a massive retroactive bonus that can easily reach 6 figures. This is why prices suddenly soften at the very end of a month or quarter. They are chasing that massive corporate bonus, not trying to do you a favor. Fourth are regional rebates, special geographic marketing cash injected directly into slow-moving territories. And fifth is floor plan assistance. Dealerships borrow money to keep cars on the lot. The manufacturer heavily subsidizes this interest expense, creating another hidden buffer. When you add it all up, these 5 quiet pipelines generate anywhere from $1,800 to $3,500 in back-end profit per vehicle before you even step into the building. But the real battlefield isn't the showroom floor. Once you agree on a price, the salesperson politely guides you down a long hallway, They sit you down in a quiet, comfortable office and introduce you to a polished executive known as the finance and insurance manager, the F&I manager. Make no mistake, this person is not an administrative clerk processing paperwork. They are often the most highly trained, highest paid, and lethal sales assassin in the entire building. Their job is not to file your documents. It is to add at least $3,000 of pure, high-margin profit to the deal. And this is where the extreme asymmetry of the transaction hurts retirees. The F&I manager runs this exact script thousands of times a year. They know every objection, they anticipate every hesitation, and they know exactly how your face will change the second they slide the contract across the desk. You're a casual player sitting across from a seasoned grandmaster, and we know exactly how much they profit off this asymmetry because publicly traded dealership giants like Lithia Motors, AutoNation, and Penske are legally required to publish their audited financial statements. Here is what the audited data shows they average in pure profit per car. First, the loan reserve, or the interest rate markup. If you qualify for a 5% interest rate, they write your loan at 6%. That tiny invisible 1% spread is pure profit pocketed by the dealer, averaging $700 per vehicle. Second, extended service contracts and warranties. This carries an average markup profit of $800 to $1,100. Third, gap insurance, bringing in a markup profit of $300 to $500. Fourth, dealer protection add-ons like wheel protection, window tints, or specialized floor mats add in an average margin of $400. And fifth, documentation and prep fees. This is pure administrative markup, averaging $800 for signing papers you are legally required to sign anyway. This brings the average F&I office profit to approximately $3,000 to $3,500 per vehicle. So think about the physics of the deal. When you walk in and proudly announce, "I'm paying cash," you just told that dealership you are stripping over $3,000 of high margin profit completely off their table. What do? They instantly adjust. They dig their heels in on the sales price, refuse to discount the vehicle, and force you to pay top dollar. By declaring cash at the door, you have surrendered all your negotiating leverage. Now, before I give you the exact counter move to beat this game, we need to zoom out. Because this isn't really about a car. It's about how you manage every major capital purchase throughout your retirement years, whether that is a kitchen remodel, a second home, helping a grandchild with a college fund, or handling an unexpected medical expense. Every single major cash distribution you make has a massive delayed ripple effect on your entire financial blueprint. It impacts your tax brackets, your investment growth, your Medicare premiums, and your long-term wealth preservation. Let me ask you a quick question down in the comments and be completely honest. Have you ever made a large purchase in retirement, like a car or a home renovation, and then been completely blindsided by a massive tax bill or an unexpected jump in your Medicare premiums the following year? Type yes or no below. I read and reply to as many comments as I can. Let's look at the actual mathematical cost of pulling a large lump sum out of a traditional retirement account to pay cash for an asset. If you pull $48,500 out of a traditional IRA in a single tax year, that distribution is treated as ordinary taxable income. If that distribution pushes you over a critical threshold, it doesn't just trigger higher income taxes. It can trigger IRMAA, the income-related monthly adjustment amount, surcharges on your Medicare Part B and Part 500 premiums 2 years down the road. A single, well-intentioned decision to pay cash for a vehicle can quietly trigger thousands of dollars in compounding tax and Medicare penalties that you never saw coming. This is exactly why we use specialized integration software with our clients. We run every major purchase through a multivariable simulator to model the exact tax, bracket, and premium impact before a single dollar leaves your portfolio. If you want to see how a major purchase would actually affect your long-term retirement security, click the first link in the description below to run a custom diagnostic with us. So, how do we defeat this system legally, cleanly, and simply? Here is the exact counter move we give to our clients. Step 1, play the part. When you walk in, never announce you are paying cash. If they ask, simply state that you are open to dealership financing if the numbers make sense. This keeps the dealer highly motivated to discount the sales price of the car because they are anticipating a massive back-end payout in the F&I office. Step 2, negotiate the bottom line. Negotiate the out-the-door purchase price of the vehicle first. Once that is locked, go into the F&I office and negotiate the interest rate and any add-ons as if you are going through with the loan. Step 3. Audit the fine print. Before you sign the contract, look at the disclosures and ask 2 critical questions. First, is there a loan origination fee? And second, is there a prepayment penalty? Under federal law, the vast majority of standard auto loans have no prepayment penalties and no origination fees. The banks don't do this to be nice. They do it because they expect you to carry the loan for years, paying compounding interest. Step 4. The clean payoff. Sign the paperwork, secure the discounted vehicle price, and drive the car off the lot. Then, exactly 7 days later, log into the lender's portal, request the payoff balance, and write a single check to pay off the entire loan in full. Let's look at the math of this play. Your dealer discount leverage saves you $3,800. Your 7 days of accrued interest costs roughly $40. That leaves you with a net savings of $3,760. By financing the vehicle for just 7 days, you preserved all your negotiating leverage, secured the absolute lowest sales price, and completely avoided paying the long-term finance charges. But here is where the strategy gets even better. Sometimes, immediately paying off the loan isn't even the smartest move. If the manufacturer is offering promotional rates like 1.9%, 2.9%, or 3.9% to move inventory, and a safe FDIC-insured high-yield savings account or CD is paying 5%, the math flips. The manufacturer is lending you money at a rate lower than what your cash can earn in a risk-free account. You are being paid to carry their debt. Furthermore, by financing the vehicle over 3 years, instead of pulling a lump sum $48,500 out of your traditional IRA today, you can spread those distributions across multiple tax years, keeping your taxable income low, avoiding IRMAA premium spikes, and keeping your retirement assets growing. My friends, retiring well isn't about finding a magic trick. It is about identifying and plugging the invisible leaks that quietly drain your wealth over a 20 to 30-year retirement. Every single dollar you keep inside your portfolio is another dollar that continues to compound and build a lasting legacy for your children and grandchildren. If you want to protect what took a lifetime to build, subscribe to the Retirement Blueprint right now. We post strategic breakdowns every single week to help you navigate the system with clarity and confidence. I'm Greystone. Thank you for watching, and I'll see you in the next video.